I'm Martin King. I'm property analyst for Edison Investment Research, and I'm joined this morning by Richard Shepherd-Cross, who is fund manager for Custodian Property Income REIT. He was instrumental in setting the REIT up in 2014 and bringing it to market. Morning, Richard.
Good morning.
I know that you feel very strongly that the commercial property market here in the UK is in much better shape than you would think by looking at the listed property sector. So before we delve into Custodian, perhaps you could say a little bit more about that and why you think it has a role to play. Investors should be looking at it.
You're right. I do feel very strongly that the fundamental strength of the real estate market in the UK is being overlooked by investors. And if we just look at our own portfolio, we can see valuation growth over the last 4 quarters, and that has been replicated across the market. We're not alone in that. And a strong recovery from the big shock that was the rise in interest rates. And of course, interest rates have been coming down, and the market really hasn't reacted to that because as interest rates fall, so we have more headroom on earnings, and as our earnings increase, so we're better able to pay dividends. And we've always paid our dividends out of earnings. So a bit of earnings headroom is good for the business and good for future growth prospects. But the real driver, the really important thing to understand about property market at the moment is we've got rental growth. And rental growth is nirvana for real estate investment. That's what you're looking for. Yes, of course, you can see capital growth through yield compression. And we saw that when we had near zero interest rates, just yield compression after yield compression. And people felt great about values rising. But all you're really doing is storing up trouble for when interest rates normalize and values settle back down to more normal levels. That's where we are now. They have settled down and they've started to see growth. But when we look at what is distracting people from investing in real estate and seeing the real value in being an income investor in a UK investment company, and you don't get more UK than UK real estate, still we are seeing people distracted by geopolitical noise, and a lot of it is noise, and also by just years of being growth-focused investors, big US tech stocks. They're still very twinkly and very attractive to a lot of investors. And I think that is distracting people from the real value there is in UK real estate, where you can invest in, this is not just a sales pitch for Custodian Property Income REIT, but for all listed real estate. But you can invest in our stock and see a 7.5% dividend yield, fully covered from earnings, with underlying rental growth. That feels too cheap.
I'll give you an opportunity to pitch for Custodian now. So Custodian, has some differences that separate it from other listed vehicles. Do you want to talk more about Custodian and what's different about it?
I think the first thing to say is we're not that different. We're just like everybody else. We're all investing in the UK market. We're all benefiting from the strong occupational market. We're all benefiting from rental growth, and we're all being overlooked. How do we do it differently? Why do we do it differently? The only real difference is in the underlying stock selection of the sort of properties that we invest in versus some of our close peers. And you can't differentiate by quality of location, quality of building, quality of tenant. But where we're different is that we will buy the smaller properties, let to those good quality tenants in good locations, in modern fit-for-purpose buildings. And we do it because that enables us to achieve a higher income return, because many of those buildings, typically sort of sub 10 million, even sub 15 million pound buildings, are overlooked by institutional investors and those investors with perhaps a lower cost of capital who are happy to buy lower yielding assets, creating a real opportunity for us that delivers, getting on for 100 basis points of additional margin. And I would argue for taking no additional risk. We're still investing in UK real estate. And in fact, by virtue of having a smaller average lot size, we have more diversification in the underlying portfolio, which of course mitigates risk.
Richard, you mentioned that rents are growing, and that's an opportunity for you to grow earnings and dividends organically.
Yeah.
You've just done a transaction, which is quite a clever thing to do. Most people are constrained by not wanting to take up debt or by being unable to issue equity. So do you want to just talk about the attractions of growth and how you managed it externally?
I think growth is always on investors' agendas. They want to see a business that has a future and is growing. And, I think we all know well that if a business isn't growing, it's probably going backwards. So we're always looking for opportunities. And we had 7, 8 years running up to the pandemic when we grew very significantly from IPO. We had a seed portfolio of 90 million. We've now got a portfolio of 620 million. So really significant growth, but it's been constrained of late. You can do corporate deals. And indeed, 3 or 4 years ago, we acquired Drum Income Plus REIT. They were a listed real estate investment trust, and we acquired them in an all-share transaction. And it is very well covered in all the property press and more widely that there's been a lot of consolidation in the listed real estate sector. So looking for other listed opportunities to merge with, take over, acquire, is a pretty thin market. So we look to the private sector. And we have recently acquired a business called Merlin Properties. Merlin had been built up by a family over 30 to 40 years. It was 22 million of property, very much in markets that we know and understand, largely in the Midlands, in industrial and in retail, and 1 or 2 small offices. They're assets that we were very comfortable with. The family behind Merlin had an issue with succession. The directors of that business were in their 70s. They wanted to pass the assets down through the generation. The next generation didn't want to run the property business, but they were all long-term investors and enjoyed the income return that they got from real estate and didn't feel that now was a good time to check out of the market anyway. So in an all-share transaction, we acquired their portfolio. And rather than giving cash for that, we gave them shares in Custodian Property Income REIT. And the share exchange ratio is calculated on a net asset value for net asset value basis. As it was a corporate transaction, no SDLT was paid, stamp duty, land tax. As a real estate investment trust, the chargeable gain that had built up in Merlin Properties gets extinguished and joining a REIT group, because as a real estate investment trust, we don't pay corporation tax. The family members were able to roll their personal capital gains tax liability into their shareholding in Custodian Property Income REIT. So there was a very tax efficient structure for them. No SDLT paid, cancelling a chargeable gain in the company, rolling in the CGT. And what that has meant is that from going from a position where they were running this company day to day and paying corporation tax on their profits and then dividending out income to the underlying investors of that business, they've saved the administration costs, they've saved the corporation tax leakage, and their net income has gone up. And they now have an equitably divisible asset in shares in Custodian REIT that they can pass down through the generations. So that's a big tick in the box for the family behind Merlin Properties. It's also a big tick in the box for the shareholders of Custodian Property Income REIT, because we've been able to grow. We've got a substantial new shareholder on the register who collectively, as a family, are long-term investors in real estate. And we think there are tens of dozens of other family property companies in a very similar position who would enjoy this very tax-efficient way to retain an investment in real estate. And of course, one of the big challenges when you're selling a property is it the right time? Should I be getting out now? Is it going to be better this time next year? And of course, for Merlin, it didn't matter when the time was, because they went from direct property to an indirect property. So if there's a recovery, and I strongly suspect there will be a recovery, then they'll pick it up through their indirect holdings. So we're very actively looking at other opportunities at the moment and looking for more if we can find them.
Perhaps finally, Richard, you could talk about the immediate outlook for the company, and also, what you see as a potential catalyst for getting investors more interested in the sector.
Yeah, I think I've touched on that a little bit already. But to put some numbers on it, if we look at the rent we're collecting today, the rent roll from the portfolio, 44.9 million, and set that against our estimated rental value, our valuer's estimate of the rental value of the portfolio, 51.4 million. Now, that's a very significant uplift in rent that will support future dividend growth. It'll also support, and let's not forget, the increasing cost of debt over time. As things stand, we have 70% of our debt fixed out till 2028 and 2032, and that gives us a weighted average cost of debt of 4%. But variable rate debt today is at 5.8. Now, if you look at the forward curve, it will tell you that we've got a period of low interest rates and then they will rise off into the future. But that forecast is about as reliable as every prior forecast we've had, which is not very. So we'll see where we get to when we come to 2028, 2032, as to how much the cost of debt will go up. But importantly, because we've got rental growth, we think it will be totally affordable for the company, which means the dividend is in good shape. And we are confident about that. So what's going to bring people back into real estate investment? I think people will finally wake up. And I mentioned it before, that value investing in UK real estate. I think it's a bit of an each way bet. If you buy listed real estate today, most particularly if you buy Custodian Property Income REIT shares today, you will get a 7.5% dividend yield. If we see asset value growth, you get 7.5% plus that value growth, and then you've locked in that dividend yield at a figure that you wouldn't be able to achieve in the future. So that's a win-win. If we don't see asset value growth, there being a growth investor was the wrong call, you've had a 7.5% income return. That's a pretty comfortable fallback position. And I think people are going to wake up to that as we get beyond the next budget, which is weighing heavily on people's minds. And it'll probably take us into next year before we start to see that confidence build back. But I'm sure it will come. We're seeing it on the ground in the underlying real estate portfolio, and that has to feed through to investor confidence in time.